feel free to put your questions in the chat. If you're brave enough to unmute and ask them live, raise your hand. I'm happy to answer questions at any time. We'll stick around at the end. So kind of a roadmap for today. We're going to talk about our recent tax law changes. We'll talk about the actual tax environment that we're in, the marginal tax system. And really, one of the key points that I want to drive home here today is how our different sources of income are going to intertwine and interact with each other and kind of show the waterfall effects of things that might happen when we take different sources of income. And then we'll wrap up by talking about how to reduce lifetime taxes. That's something that we're all looking to learn some more about. So that is what we'll do here this evening. So if this right here is a look at our married filing jointly marginal tax rates. Okay, it's probably something that we've all seen before. So it should not be anything new to anybody. But one thing that I do want to reiterate and kind of drive home is that with the marginal tax rates, a common misconception that people experience is that they feel that if they go into a higher tax bracket, that all of their income gets taxed at that tax rate, and that is just not the case. When we go into a higher tax bracket, so for instance, in this scenario, if we're working with a couple married filing jointly, if they earned $208,000, only that last $1,300 above $206,700,000 gets taxed at 24%, not the whole amount. So I just want to kind of make sure that everybody is clear on that. So this is what our tax brackets would look like in a graphical format. I like to show them in an illustrative format as well. Sometimes it's a little bit easier to comprehend. Again, showing you that as we move along in income, as our income increases, only those final dollars get taxed at those higher rates. So you'll see the 3 green arrows on this tax map. Those represent the 3 largest areas of planning, or the 3 largest jumps in tax rates. So something to keep in mind. One thing I do want to point out here, if you look at that first green arrow pointing at the 10% tax bracket, that doesn't even come in to play until around $33,000. And the reason for that is the standard deduction. And I'll show you how that comes into play going forward. So let's talk a little bit more about our marginal tax rates. So we have our marginal tax rates, and we kind of went over how it's only the last dollars that fall into those marginal tax rates will get taxed at the higher rate. Our capital gains have the same marginal tax rates. Now the same marginal tax system. Now the rates are a little bit different, but they still have the same concept. So why do we have this difference between ordinary income tax and capital gains tax rate? Well, the reason for that is they give beneficial tax treatment to capital gains because what they're trying to do is get you to invest in the economy, invest in policy to help stimulate the economy. So in order to do that, they're going to give you a beneficial tax rate. Some of the areas that we get beneficial tax rate is on buying or selling real estate, buying or selling stocks or bonds outside of our pre-tax retirement accounts. Those are some areas where we get beneficial tax rates. Again, they have a similar marginal tax concept, just the rates are a little bit different. So what would that look like? For a lot of people, when they hear the term capital gains, they automatically think 15%. My capital gains are taxed at 15%. And for a lot of us, that is going to be the case. But in reality, your capital gains don't get taxed at 15% until you exceed $96,700 in total taxable income. So if you have less than that $96,700 in taxable income and capital gains combined, any capital gains that you have will not be taxed at all. So that's something to keep in mind when we're trying to do some of our proactive tax planning. Meaning, if you're retired or at any stage in your life and you have only $50,000 in taxable income, that means you could absorb an additional $46,700 in capital gains and not pay any tax on that. So something to keep in mind that not all capital gains are taxed at 15% like we all intuitively think. Again, here is a tax map of what capital gains would look like, showing that the difference. For the large majority, the largest portion of our income would make up the 15% tax bracket for capital gains, but not all of them. Let's go through a couple of different examples to show how different sources of income get taxed in different ways because of when and how we receive the income. So for our first example here, what we are showing is $100,000 in capital gains, non-taxable capital gains. The reason why these capital gains are non-taxable is because they fall underneath the 96,700. Now, in your head, you're thinking, no, Greg, 100,000 is more than 96,700, and you are correct. But what we are taking into account with that would be the standard deduction. And the standard deduction for our married couple filing jointly under the age of 65 is $30,000. Once we go over the age of 65, each 65-year-old gets an additional $1,600 that counts towards their standard deduction. And we'll talk more about that here in a little bit. So in this example, somebody receiving $100,000 in capital gains would receive no tax or have to pay no tax. Now, in our next example, we have the same $100,000 in capital gains, but in addition to that, we take a taxable distribution from our IRA of $30,800. Now, that first $30,800 is going to be absorbed by the standard deduction. Then we stack our capital gains on top of that, which causes $4,900 of our capital gains to be taxed at that 15% capital gains rate. So not terrible, less than $5,000 taxed at 15%. That only comes out to be about $750. Okay. I'm sorry, that closer to $75. Our next scenario, we have a larger IRA withdrawal. In this scenario, we have a $50,000 IRA withdrawal. The first $30,800 gets absorbed by the standard deduction. The next $19,200 is taxed at the ordinary income tax rate, and that will push out of our $100,000 in capital gains $30,050 to be taxed at the 15% capital gains rate. So again, showing you how as we stack income, more and more income, the results of the taxation on that. So let's talk a little bit about how deductions and credits will work for you going forward. In 2025, the standard deduction for a married couple is $30,000. Now, this was changed dramatically back in 2017 through the Tax Cuts and Jobs Act. Through the Tax Cuts and Jobs Act, they eliminated personal exemptions and tried to simplify the tax filing process through the increase of a standard deduction. So married couples have a $30,000 standard deduction. Single filers have $15,000, exactly one half of that. It is something like 85% of people, of Americans filing their taxes will file under the standard deduction. However, it is still possible to itemize your deductions. And the only time you would do that is if you're by itemizing your deductions, you exceed the standard deduction. Some of the areas that we can itemize our deductions on a Schedule A would be our mortgage interest. If we have mortgage interest on debt up to $750,000, then we could deduct that interest that we paid each year. Our charitable gifts would be deducted if we get to itemize our deduction. And that's a key misconception that is often overlooked. Just because you make a charitable contribution in the year doesn't mean you get to deduct that charitable contribution unless you're itemizing your tax return. Okay, so if you're filing under the standard deduction, your charitable contributions will do nothing for you from a tax standpoint. They are great to do if you're charitably inclined to give back to the community, but they do nothing for you from a tax standpoint. And the last area of major interest when it comes to itemizing our deduction would be our state and local property taxes. And we can deduct up to $10,000 of state and local property taxes. That is what you may have heard as the SALT deduction. Okay. I mentioned briefly previously that if you are over the age of 65 years old or you are blind, you get an additional deduction of $1,600. So for a married couple over the age of 65, their total standard deduction is $33,200. Okay. That is how our deductions work. Again, the majority of us are going to file under the standard deduction. If you do itemize your deduction, then we'll talk about some strategies later on here in the presentation where you might be able to do so. Then you can take advantage of higher deductibility other than the standard deduction. The next thing that we have after deductions are tax credits. Now, tax credits are used to incentivize behavior, and some of the tax credits that we experience are the healthcare tax credit, earned income tax credit, savers credit, child credit, okay? So these are all credits that we use to incentivize behavior. Again, for example, the child credit, we know that if we have children that we are claiming as dependents, we get a tax credit for that. A more obscure one, the savers credit. If you are over the age of 65 and contributing to a retirement plan, you will get an additional tax credit to go along with your income deductibility. So let's take a look at a quick example based on our 2024 tax year, okay? So in this scenario, we have a married couple that has $40,000 in gross income. This could be from wages, from pension, from IRA distributions, but they have $40,000 in ordinary income. Because they are over the age of 65, they will get the $30,000 standard deduction plus the $1,600 over the age of 65 deduction for a total of $33,200. Not only that, they are still working, so they made a $2,000 contribution to an IRA, so they deduct that $2,000 from their income, which leaves $6,800 of total income subject to tax. Now, that tax would fall into the 10% tax bracket, which would be $680 of tax due. But because they were over the age of 65 and contributed to an IRA, they will receive a savers tax credit of $1,000, reducing their total tax bill down to zero. Now, one thing you will notice through this tax credit, they do not receive a tax refund for the difference between $1,000 and $680 because this is a non-refundable credit. So all that does is zero out their total tax bill. So in this scenario, a married couple making $40,000 a year will pay no tax. So some things that we have to keep in mind, again, looking at the arrow on our tax map, going up to the $30,000, that is where the first $30,000 of income would falling under our standard deduction. Now, if that was all that we had to take into account for our tax system, it would be pretty easy, but we know that's not the case. We have all of these different areas and more to take into account when trying to calculate what our total tax liability would be. The first would be required minimum distributions. We briefly touched on capital gains, Social Security benefits, and how that income from Social Security coordinates with our overall income taxation. Our Medicare premiums are affected by our total income, potential Roth conversions or large IRA withdrawals, net investment income tax, and alternative minimum tax. Now, alternative minimum tax is a very, very rare form of tax. Most people will not fall into it, but if you do, you know that you do, and you know how painful it is. How do required minimum distributions work? Okay, in order to calculate our required minimum distribution. So first, let's take a step back and try and talk about what a required minimum distribution is. A required minimum distribution is at age 73, the government is going to force you to start taking withdrawals from your pre-tax retirement accounts. So your IRAs, your 401ks, SEP IRAs, simple IRAs, 403bs, anything that you have been deferring tax. Beginning at age 73, the government is going to say, you have deferred tax on these funds long enough. It's time for us to start collecting some tax revenue. We are going to force you to take a minimum out each year. In order to perform this calculation, you take the previous year end balance. So to calculate your 2025 required minimum distribution, you would take the balance from December 31st, 2024, in total, all of your pre-tax accounts together. You would take that total amount, divide it by the divisor on the IRS Uniform Lifetime Table, which I'll show you here in a moment, and calculate what your required minimum distribution would be. So for a 73-year-old in 2025 who had an IRA balance of $500,000 at the end of 24, their required minimum distribution would be $18,868. That means they are required to take out at least $18,868 so that can be taxed. They could take out more, but they could not take out less. If they decided that they did not want the required minimum distribution, they had no need for the money, they did not want to pay the tax bill, then the IRS would come back to them and say that we are going to penalize you 25% on everything you should have taken, plus tax on the full amount as well. So in theory, you could be losing up to 50 or 60% of what you should have had, depending on what your income tax bracket is. This is an example of the IRS Uniform Lifetime Table. As you can see, there is a distribution period, or what we call a divisor, next to each age. As your age goes up, the divisor number goes down, which means the amount that you actually have to withdraw from your IRA each year will go up. This gets calculated all the way out until at least age 120. If you are still alive at age 120, they're going to say you have to divide your IRA in two and take out half of it. If you're still alive at 121, you are going to keep dividing by half. So God bless you if you're alive at 121 and still have IRA funds around that we have to take RMDs on. Okay. So I don't know about anybody here, but I'm a little anti-authoritarian. I don't like when the government has to tell me what to do or wants to tell me what to do when it comes to taking distributions. So I try in my planning for myself and for a lot of my clients, what I'm trying to do is avoid required minimum distributions. And we'll talk about some strategies to avoid that or postpone that altogether. Now, after our required minimum distributions, we have capital gains. And we talked about how capital gains have a similar marginal tax setup as our ordinary income. Now, what we're trying to do is determine how and when we're going to pay capital gains. Now, we know if we buy and sell real estate that we have to pay capital gains on any appreciation in that real estate. The same is true for any stocks that we might buy. If we bought $1,000 worth of Apple and it's now worth $100,000, we would have to pay capital gains on the difference, that $99,000. And we would pay that at whatever our capital gains tax rate is. Now, that makes sense to a lot of us. But what a lot of people don't take into account are what I call phantom capital gains. And this is for people that own mutual funds in their non-IRA accounts. So they're after-tax brokerage or joint accounts, okay, if we own mutual funds in there. Here we are during tax time right now, so you've probably gathered all of your tax documents and turned them over to your accountant. And you might be reviewing the 1099s that you've received. And you received a 1099 from your investment company saying that you had capital gains in your brokerage account. And you scratch your head a little bit and say, well, I don't understand how that happened. I didn't sell anything. I didn't have any gains. But what you may or may not understand is that by holding mutual funds in those accounts, they are buying and selling stocks and bonds in those mutual funds all throughout the year. And at the end of the year, they pass on those gains to you, the shareholders, each year. So even though you didn't physically sell any shares of the mutual fund, you will still be liable to pay capital gains on the turnover within the fund itself. Something else to keep in mind is if you're rebalancing your portfolio on a regular basis, this could cause you to have some capital gains. And as we showed in our previous income example, long-term capital gains could cause ordinary income tax to become taxable that otherwise may or may not have been. So one strategy that we'll talk about a little bit later on is what we call asset location. Asset location is different than asset allocation, where we're talking about investing in different asset classes. What we mean with asset location is holding different investment types in appropriate accounts to efficiently manage our taxes. So in my after-tax, either joint account, brokerage account, trust accounts, I like to hold ETFs or exchange traded funds and non-dividend paying individual stocks. That will allow me to control any tax liability that I have because they're not going to pay any unwanted dividends. They're not going to pay any unwanted capital gains. I am not anti-mutual funds. I just know that if I'm going to hold my mutual funds, I want to hold them in my IRAs, my 401ks, my Roth IRAs, so that I can control the tax liability within those. Okay, so those are some things to keep in mind on how to mitigate and control the taxable, the capital gains to when we want to pay the capital gains. Another strategy that we do a lot at our firm is called tax loss harvesting, or there's tax gain harvesting. And all we're doing there is selling some winners, selling some losers to try and offset the gains and bring the portfolio back into balance without triggering much of a taxable event. So Social Security is taxed based on your other income. And the way that Social Security is taxed is they use a calculation called provisional income. Now, provisional income is not anything that you will see on a tax return anywhere. It's not adjusted gross income or modified adjusted gross income. It's a term that's used purely for calculating taxation on Social Security. And the way that it's taxed is they take 50% of what your Social Security benefit is, any ordinary income that you would have from wages, from pensions, from IRA distributions, any dividends and capital gains, any non-taxable interest that you receive. So if you are invested in municipal bonds, and we know that interest from municipal bonds is generally not taxed, they are still going to include that non-taxable interest in the calculation for the taxation of your Social Security. And what they're going to say that is, if you're married filing jointly and you have less than $32,000 in provisional income, we aren't going to tax any of your Social Security. If you have between $32,000 and $44,000 in provisional income, we're going to tax up to 50% of your Social Security. And anything over $44,000 in provisional income, we're going to tax 85% of your Social Security. Okay. And they're going to tax it at whatever your income tax rate is. So you can see the threshold for Social Security taxation is very, very low. And this is something that we need to take into account when trying to coordinate our sources of income in retirement. How much should we be taking from our pre-tax accounts versus our taxable accounts versus our tax-free accounts with the Roth to optimize our Social Security income? Now, let me say this. When it comes to calculating provisional income, I've been out here talking about Social Security for over 15 years, and they have not adjusted these provisional income limits at all. Okay. They have remained at this level for that period of time and longer. I do not know if they're going to adjust them anytime soon. I just want to demonstrate that the threshold is so low. It's less than $4,000 a month in income, and you're going to be paying tax on your Social Security. So to kind of show you a tax example of how that would look, I have two different scenarios here. Two different people that have $60,000 in total income, but they receive it from different sources. In the first example, somebody receives $20,000 from Social Security and the remaining $40,000 from an IRA withdrawal. In the other example, $40,000 from Social Security and $20,000 from the IRA withdrawal. And what I kind of want to show you here is they have different provisional incomes based on the calculation. So in the first example, they have $50,000 in provisional income. And in the second example, they have $40,000 in provisional income. And the way this would look like in calculated out, and the difference in the tax is, for our first example with the larger IRA withdrawal, they have $11,100 in taxable Social Security, other taxable income of $40,000 for total taxable income of $51,100. Okay, let's take away the standard deduction. That leaves a net taxable income of $17,800 for total federal income tax due of $1,780. Now, flip-flop our IRA withdrawals versus our Social Security income, and it comes out to a very different tax result, showing that no taxes owed in our second scenario. So what I want to illustrate in this example is, and I spend a whole hour talking about Social Security claiming strategies, is intuitively, a lot of people want to take Social Security as early as they possibly can because they're not sure if it's going to be around for them. But one thing to consider is trying to get our Social Security benefit as large as we possibly can to fulfill our income needs will benefit us from a tax standpoint in the long run. We mentioned that our Medicare premiums might be affected by our total income. So again, for a married couple, if you have less than 212,000, you are going to pay the standard Medicare Part B premium of $185. It's as you start to creep above that $212,000 limit that your Medicare premium will go up. Now, these Medicare premiums are per individual. So again, if we're married filing jointly, that we're over $212,000 in that first threshold, that would be an additional premium for each person, not just one. Okay. So I don't work with a whole lot of clients that have income, regular income over $212,000, but some things to consider where we might have additional income in a year. Maybe you receive an inheritance one year. Maybe you do a large IRA withdrawal to pay for a car, to pay for a home, or you do a Roth conversion. That would generate additional income for you, which would impact your Medicare. Now, your Medicare premium isn't permanently increased. It's only for 1 year after they recalculate. After that, they will recalculate it based on the next year's income. So something to keep in mind. So this applies to both Medicare Part B and Medicare Part D. So when it comes to paying our Medicare premiums, it is based on our income 2 years in arrears. And the reason for that is they do not have our 2024 income yet because we have not filed our taxes yet for 2024. We are in the process of doing that. So they will use their 2024 tax returns to calculate our 2026 Medicare premiums. The next tax area we have to take a look at is the net investment income tax, okay? And this is for anybody that has investment income over 200,000 for singles, 250,000 for a married couple. This could come from capital gains and dividends, interest and annuity payments, passive income, or rents from real estate investments. If we start to exceed that $250,000, then we're going to have to pay an additional 3.8% tax. Real quickly to talk about alternative minimum tax, okay? This is a flat tax of 26 to 28% of income over a high threshold, okay? Again, if anybody is paying AMT, you know it and you know how painful it is. So only 0.1% of taxpayers were impacted by AMT in 2024. Now, some deeper tax planning discussions that we need to evaluate. Number one, should I convert to Roth? Roth conversions are a hot topic, and it's something that everybody should consider. I'm not saying everybody should do a Roth conversion, but everybody should consider it. Some things that we need to take into account when deciding whether or not to convert to Roth is, what is our purpose for converting to Roth? Is our purpose to provide us a tax-free income later on in retirement? Is our purpose to convert to Roth to leave a tax-free inheritance to our heirs? Okay. If the purpose is to generate a tax-free income for ourselves in retirement, then let's be proactive and start to do the calculations to find the optimal amount that we should be doing, either on an annual basis, if not converting larger chunks fairly soon. If our point is to leave a tax-free inheritance to our heirs, then let's do a calculation and see who's in a higher tax bracket right now. Are you in a higher tax bracket than your kids? If that's the case, then it wouldn't be prudent for you to do a Roth conversion right now and pay those higher tax brackets. If they are in the higher tax bracket, let's say they're a doctor or a lawyer or a high earning professional, then maybe it would make sense for you, being in the lower tax bracket, to convert the Roth to leave them a tax-free. You also want to evaluate how your heirs are going to use the money. If they are going to inherit your Roth IRA and then just go turn around and buy a boat with it, well, then maybe you want to reconsider on whether or not you should pay tax on that, or let them handle the tax liability if they're going to squander it. If they're going to stretch out their distributions or use it for their own retirement planning, then it may be more beneficial again for you to pay the tax versus them. So everybody's situation is going to be a little bit different when it comes to converting to Roth. One thing that I like to stress is that we are in a very tax-friendly environment right now. So taking advantage of these lower tax rates that we're in. Right now, the current tax system that we're in is set to sunset in January of 2026. Now, with that being said, the administration that put these tax laws into effect is now our current administration again. So I would expect these tax rates to get extended for a period of time. So I am encouraging a lot of people to take advantage of these lower tax rates. That is something that we are in tax rates that a lot of us have never seen before. We know that in the future, we have an over $30 trillion deficit for our country. We're going to have to pay that off at some point. So if we can do that, if they're going to raise tax rates in the future, which I think all of us would agree that at some point they will, why not lock in these ultra low tax rates right now? If anybody here remembers back to the 70s, in the 70s, there were tax rates as high as 75%. So a 75% tax rate looks ungodly compared to the highest tax rate that we're in right now of 37%. So something to keep in mind when evaluating whether or not a Roth conversion is right for you. Again, some of the unintended consequences we have to take into account. Will it increase our Medicare premiums? Will it cause capital gains or other income to be taxed at a higher rate? Things like that. If you are going to decide to convert to Roth, you will have what is called the 5-year rule. Now, this only applies to those that are converting to Roth pre-59 and a half. If you're going to convert to Roth after age 59 and a half, this is not applicable. So if you're converting before age 59 and a half, each conversion period will have its own 5-year waiting period. You must wait until after 59 and a half to avoid any 10% penalty. Any penalty is assessed on the earnings only, not any contributions or any principal that you have paid tax on. For my clients that are charitably inclined, there's 2 different methods that we use to try and massage a better result for our charitable donations. And one is through the use of a donor advised fund. So let's say, for example, you give $10,000 a year to your church. But each year you file for the standard deduction. So you are not getting the charitable contribution tax break because you're filing under the standard deduction. One thing or one strategy that we use is what we call charitable bunching. So instead of giving $10,000 a year to the church over each year for the next 3 years, what if we contributed $30,000 this year to a donor advised fund, which would take us up to the standard deduction limit, which would then allow us to deduct our property taxes, any mortgage interest that we have, any additional charitable contributions that we have, and allow us to itemize our tax return for that year and still fulfill our charitable obligations or our charitable wants. Now, when we put the $30,000 into a donor advised fund, that does not mean that the charity or the church or whoever we choose gets that money right away. You get to decide how, when, and the frequency in which they receive their contributions. So if you still wanted to do $10,000 each year, you would just send $10,000 from the donor advised fund each year to the charity of your choice. The key thing here is when we contribute to a donor advised fund, any distributions from the donor advised fund has to go to a qualified charity. So we can't contribute to a donor advised fund and then send money to our kids or anything like that. So we could also give gifts of non-cash assets. We could, if you have a highly appreciated stock, maybe you bought company stock, or you've just held on to some stocks or mutual funds for a long time, you can give those to a donor advised fund and take advantage of the charitable contribution that way. That way we avoid costly capital gains. Another way that we can give to charity is through what's called qualified charitable distributions, or QCDs. QCDs allow us to make distributions directly from our IRA for those over 70 and a half to a charity of our choice and not incur any income tax from that. QCDs can also be used to satisfy our required minimum distributions for the year. So going back to our example of our calculation of a 73-year-old that has an $18,000 RMD, if we wanted to give $10,000 to our church, we could do a QCD of $10,000 directly from the IRA to the church, and we would not pay any tax, and then withdraw the remaining $8,000, and that would satisfy our required minimum distribution for 2025. We would only pay tax on the $8,000 that we received. So it's not an all or nothing. You can break it up however you want. The only limit is you can only do up to $105,000 in 2025. You can also do QCDs made directly to a donor advised fund. So ways to kind of massage our charitable giving and take advantage of our tax deductions because of it. So we talked about our marginal tax rates and how the last dollars that fall into that are where we're going to pay our tax. So what we need to look at is our effective marginal tax rates, or our average tax rate, because what we want to do is divide our income out over the different tax brackets to try and know what our overall tax rate is going forward. So here's another look at our tax map for 2025, again, looking at our marginal tax rates, and again, our tax map for our capital gains rates. So let's go through one more case study for a couple. And here we have another 65-year-old couple, married filing jointly, that has $64,000 in Social Security income, $10,000 of long-term capital gains, and $53,000 of IRA withdrawals. Now, taking a look at how their income tax map would look if we laid it out graphically, you can see at one point they're paying almost 50% on their taxes. And you might be thinking to yourself, what's going on, Greg? How is that working? Well, let's take a look at how this shook out. In this scenario, we had that couple that had that same income source, but they needed an extra $1,000 IRA withdrawal. Okay, they needed an extra $1,000 in income. Maybe they needed to pay a car payment, a car repair, or they wanted to give a gift to somebody. Intuitively, based on the income that they have and the calculations that we have, we would think that that extra $1,000 would pay a tax of $120 because they would fall in the 12% tax bracket. But here's what actually happened. On that calculation, that additional $1,000 withdrawal, yeah, we have to pay $120 on that $1,000 withdrawal, but it also causes $850 of Social Security to become taxed, which is another $102 in tax. It caused $1,850 of capital gains to become taxable at 15%, which comes out to be $277.50. So a total tax burden on a $1,000 withdrawal of $499.50. So almost 50% of their money was lost because of this trickle-down effect. This is what the capital gains tax torpedo would look like as well. So what we're trying to illustrate with that example is to make sure that when it comes to needing some additional income, we don't just go to the easiest source or the source that has the most money. Let's think about where all of our sources of income have come from and what the tax result will be going forward. So what are some tools that we can use for tax control going forward? Well, we know that there's diversification when we're building our portfolios between stocks, bonds, cash, alternative investments. I think it's just as important to have tax diversification as well. We need to have some pre-tax diversification, some post-tax or taxable accounts, and then we want some Roth or tax-free accounts. Having a little bit of money in all three of those accounts will allow us the most flexibility during our retirement years. Number two, when appropriate, consider tax-deferred products. If we have a large amount of cash invested in CDs and we're paying income on that interest income each year, maybe instead of using a CD, you might consider an annuity, okay, to defer the tax on that each year. Number three, we just talked about it during our last case study, properly blending withdrawals from different accounts, making sure that we know that when we make a withdrawal from an account, we know what the overall tax implication is going to be, and not just we know we're in the 12% tax bracket, we're only going to be taxed 12% on this. And then lastly, consider which asset should be held in which account type. This is our asset location discussion. Again, I like individual stocks and ETFs in my taxable brokerage accounts, mutual funds, ETFs, dividend paying stocks, and bonds in my IRAs, and then my aggressive growth funds in my Roth IRAs. And that is how we can effectively manage a better tax result for you. So to kind of wrap up, everybody's tax map is going to be vary greatly, okay? So a quote that I like to share: anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the treasury. There's not even a patriotic duty to increase one's taxes. So where I go with this is I'm okay paying tax. I know that taxes are necessary, that we're going to have to pay them in our lifetime. I just only want to pay my fair share. I do not want to leave a tip to the IRS. Okay. So for anybody that attended our presentation here this evening, I'm happy to give a complimentary tax analysis. This is where we take a look at your last year's income tax return, whether that be 2023 or if you filed 2024 already, we can take a look and provide you some tips or some areas of opportunities to consider when approaching your tax planning. So that's free of charge to anybody that attended here this evening. This is my contact information. You can also scan the QR code and get some time on my calendar. This is not a sales appointment, okay? We're not trying to sell anybody on any services, just provide the tax analysis so that you have a better idea and you can possibly be more proactive on your tax planning in the future. So with that being said, are there any questions here?
Hi, Greg. This is Brian. How are you today?
I'm fantastic, Brian. Thanks for being
Time
great.
I've actually learned something here, and I just want to confirm my takeaway. I actually have a small inherited minimum distribution account, and I've been killing myself because the minimum distributions happening at the end of the year obviously put me in a higher tax bracket, progressive tax bracket. But what I think you were conveying is I could take that earlier in the year, avoid the progressive tax increase, or I could potentially, if I'm having a lower earning year, I could take it all at once and take advantage of the tax year that I'm having, so to say. Does that make sense? Is that what you were conveying?
So your second assumption is correct. If you are having a lower income year, I would encourage you to take more than the required just to try and get some money out of there.
Mm-hmm.
The timing of the distribution throughout the year has no impact. So when we talk about a marginal tax bracket, it doesn't mean throughout the year. It's just looking back on the total income for the year. So whether you took it on January 1st or December 31st, the same tax result would be the end result.
I guess you're right, because it's cumulative.
Yeah,
You're
it's
correct.
cumulative. So yeah, so that would not have any timing in the year, has nothing to do with the tax result. But in a lower income earning year, yeah, I would definitely encourage you to take more.
Okay.
Now
And
the
then
question is that IRA, is that inherited IRA, was that inherited pre-2020 or post-2020?
free.
All right, so you get to stretch it out over your lifetime.
Right.
Anybody that inherited an IRA after 2020 only has 10 years in which to use all of that money. Otherwise, they incur penalties.
Yeah, they'd always ask that when it was inherited. I got a second question for you.
Sure.
In terms of that donation play there, can you do that before April 15th, or do you have to do that before the end of the calendar year?
It's before the end of the calendar year. So if you tried to do it now for April 15th, it would count for 2025, not 2024. The only thing that we're allowed to do for retroactive is contribute to IRAs. Yeah, that's really the only thing that you could do in 25 that would help for 2024.
Gotcha. Thank you. Thank you again for your time.
My pleasure. Are there any other questions out there? Well, hearing none, Emily, I think that wraps us up for. Oh, I see somebody put something in the chat. Oh, thank you, Marcia. I appreciate the kind words. Um, I think that wraps us up for the evening, but I encourage anybody here to take advantage of the tax analysis. Like I said, scan the QR code, or this is my contact information. You can get a hold of me pretty easily, and we can do the tax analysis for you.
Thank you so much, Greg. We learned a lot. Thank you so much for your time, and we look forward to hearing back from you.
It's my presentation. It's my pleasure. Thanks, Emily.
Thanks. Have a good night.
Talk to
Bye-bye.
you soon.